Welcome to Winning by Not Losing, the podcast where we explore how to manage risk without losing your balance, even when markets look like they've had one drink too many. I'm your host, and joining me again is Sudhir Holla, CEO of myStockDNA. Sudhir, great to have you back.
Always a pleasure. And though I have to say, lately the markets have looked a little unsteady on their feet.
That's one way to put it. We've seen the NASDAQ drop 3.5% in a single day, headlines screaming crash, and then somehow we're back near all-time highs a week later. So Sudhir, help us out. Is this normal market wobble or something more serious?
That question was exactly the premise behind my post QQQ Just Fell 3.5%. Is the market tipsy or having a heart attack? The analogy is simple but powerful. When markets stumble, are they just a bit drunk, overreacting, overextended, but fundamentally fine? Or are they showing symptoms of a heart attack, something structurally wrong underneath? That distinction is the very foundation of technical trading. Every pattern you've ever heard of, the flags, triangles, head and shoulders, double bottoms, is really an attempt to answer one question. Is this a continuation or a reversal? A continuation pattern says the market's just tired and catching its breath. A reversal means the trend itself is changing, the heart's under stress. And statistically, most of these sharp drops are just signs of fatigue. Since 2005, QQQ has had over 100 days where it fell more than 3%. In nearly 3 out of 4 cases, the market bounced back within weeks. So the data tells us most of the time the market is just winded, not dying.
So it's not every stumble that means we're headed for the emergency room.
Exactly. A spike in your heart rate after a sprint isn't a crisis, but chest pain after weeks of bad habits might be. The key is context. Where the market stood before the fall. That's what separates a hangover from a heart attack.
That brings us to your other piece, dancing on bubbles. You described the current market as a mix of fear and euphoria, almost like everyone knows the music will stop, but keeps dancing anyway.
Yes. And that's what makes this stage so psychologically difficult. The market's in what we call a melt up. Everything's running hot, valuations are stretched, and sentiment is euphoric. The instinct for many investors is to move to cash before it all bursts. But here's the paradox. History shows that the final phase of a bull market often produces some of the largest gains. The year before most peaks, equities delivered double-digit returns. When Greenspan warned of irrational exuberance in 1996, the Nasdaq tripled before the bubble actually popped. Investors who exited early missed out on 3 of the most profitable years in history.
So the cost of leaving too soon can be just as painful as staying too long?
Exactly. Trying to time the top is like leaving a great party because you're afraid someone might spill a drink. You'll probably miss the best song of the night. That's why our focus is risk management, not market timing. Stay in the game, but wear a seatbelt. Diversify. Rebalance. Use systematic stop loss or trend following rules that allow you to react when the data actually changes, not when your emotions do. That's how you keep dancing without falling through the floor.
That's a perfect segue into your recent post. Buffett has cash, you have questions, and that's okay. Everyone's been talking about Buffett sitting on record cash. Some investors are taking that as a sell signal. Should they?
Not at all. Buffett's strategy and ours operate in 2 completely different dimensions. Buffett is a fundamental investor and he's driving a massive trailer down the market highway. When you're hauling that much weight, running $1 trillion company, you don't switch lanes suddenly. You move deliberately and only when the path is clear. His cash pile isn't fear, it's a strategic reserve, liquidity for acquisitions, buybacks, and opportunistic investments when markets truly dislocate. Now, our approach through Darwin is like driving a nimble car alongside that trailer, and we can react faster. We don't have to predict every turn, but we can adjust when the road conditions change. Because when you're nimble, you can afford to rely on both reaction and prediction. Prediction helps you anticipate, reaction lets you adapt. And the combination of both is what keeps an active risk managed strategy resilient through uncertainty.
So Buffett's calm comes from size and patience, while your approach achieves calm through adaptability.
Exactly. Both are forms of discipline, one slow and steady, the other responsive and flexible. The key for investors is knowing which vehicle they're driving and not trying to steer a trailer like a sports car.
So whether the market's drunk, euphoric, or nervous, what does winning by not losing look like right now?
It looks like calm, and calm isn't about doing nothing. It's about doing the right things consistently. Diversify your portfolio across risk on and risk off assets. Build time diversification into your rebalancing schedule. Use objective data driven rules that take emotion out of the equation. When the market feels drunk, you don't need to predict its next move. You just need to keep your balance. The investors who survive aren't the ones who outguess the market, they're the ones who outlast it.
So calm isn't passive, it's an active discipline.
Exactly. Calm is the quiet confidence that your plan can handle both the sprint and the stumble.
That's a great note to end on. Sudhir, always a pleasure having you.
Likewise.
And to our listeners, remember, markets can act drunk, overconfident, or panicked. But your portfolio doesn't have to. Stay balanced, stay patient, and as always, keep winning by not losing.